All right, let's take a look now at how markets are reacting to the news of a 75-point hike. Yahoo Finance's Jared Blickry here with the numbers behind that.
I got to tell you guys, not a whole lot of movement yet, but that's what we expect. What's unusual about today is how much we drifted up. In fact, we shot up ahead of this announcement, I think a tribute to the volatility. But this is it. That's all we have so far. Of course, the real fireworks, they start at 2:30, and we're going to be covering that as well. Want to check in on the sector action for the day, and we are seeing in the lead now, it's still the mega cap sectors. We got communication services, that's XLC, that's up 3%, XLK, XLY, that's tech and consumer discretionary. Each of those up more than 2%. But I want to take a look at the bond market. This is a 10-year T-note yield, really not doing much, down about 3 basis points. But let's check out that red line statement. This is the latest announcements compared to the June announcement. And we see recent indicators of spending and production have softened nonetheless. And so they are downgrading their growth expectations. Neil Dutta over at Renaissance Capital, he was writing about this. We didn't really learn much, but we have that presser. So 75 and 75 plus lowering their growth expectations. I did get some movement in some other sectors here. Want to check out the euro. That is still roughly at parity with the dollars. Check out a chart here. Not a whole lot of movement. Also taking a look at some of the commodities, which don't always track the Fed decision, but WTI has been on the move, and you can see just a little bit of movement here. It did shoot up earlier today on an inventories report. And here's the most hilarious part of the day for me, Bitcoin. Bitcoin is a big leader in all of this. Shot up on the statement. Why? Why not?
I was going to say, it's hard to make sense of anything that happens in the crypto market. Jared, real quick before you go, the spread between the 2 and the 10-year, we know that was in focus with these results. We haven't seen a heck of a lot of reaction in the bond markets. Is that similar to because of what we're seeing play out in equities is largely priced in? It's
priced in, but what's not priced in is what Powell is going to say. I think he's going to try to toe the line. He's done this before many times. Early on in his career as Fed chair, he kind of fumbled a little bit, and he's learned from that. So I think he's going to stay the course. But the real reaction in the bond market, Shauna, that is definitely going to happen in the presser. If there is any, who knows?
We'll have to see. As you mentioned there, why not? All right, well, let's check in with the Conference Board Chief Economist, Dana Peterson, to break down some of this action that we're seeing today. And Dana, in your notes, you were also expecting this 75 basis point hike. But what does this mean for people and their mortgages? What should they be taking from all of this?
Well, I think it means that mortgage rates are going to continue to rise and that we're going to see some pullback in the housing market. We're already seeing starts and permits come off and sales. And that's a function of, yes, very elevated prices. That's affecting affordability, but also rising interest rates. And we think that's going to definitely show through in the GDP data that's coming up. And also when we look at our own confidence measures, people are saying that they're pulling back on their expectations for home buying.
And some more data on home sales today. Pending home sales plummeting 20% year over year as mortgage rates continue to climb, to your point. Is this cooling of the housing sector saying that the Fed's job is working a bit?
I think so. This is what the Fed wants to see, a calming in domestic demand, and certainly housing is a big part of that. Housing activity spiked during the pandemic as interest rates fell to historical lows. Also, many people were looking to upgrade in terms of their space and moving out of big cities and into suburbs and smaller cities to get more room. And then you also have millennials. They're all turning 40 and they have families and they're looking for that next upgrade in housing. And so all those things are demand that the Fed wants to tamp down on.
Dana, the second 75 basis point hike that we just got this afternoon, is it enough to help or to get inflation to begin to moderate?
It's probably not enough. We expect the Fed will continue to raise interest rates. Whether they go 50 or 75 basis points in September doesn't really matter. The point is that the Fed is going to be raising interest rates into what we think will be restrictive territory, anything above 3%. And they'll probably get close to 4, maybe a little bit over that by early next year. And we think that that action, that very aggressive stance against inflation, will actually induce a recession, probably starting an actual recession that the NBER would agree that it is one, probably starting in the fourth quarter of this year.
And so how key is it going to be when we do get that GDP data, given the other strengths that we see in the economy with employment, how should we be viewing this? What lens should we be viewing this recession through?
Sure. I think, well, just thinking about tomorrow when we get second quarter GDP, it could be slightly positive, it could be slightly negative. But again, domestic demand is probably going to be strong. That's consumer spending and business investment and even still housing. And then we look at the labor market, that's still quite powerful. We have 11.3 million job vacancies. The unemployment rate's at near historic lows. So I think moving forward, we're really going to have to look at not just GDP prints, but what's happening with respect to domestic demand, with respect to income, whether incomes start to come off. And certainly if the labor market worsens with higher jobless claims and fewer payrolls and an uptick in the unemployment rate. We have to look at all the indicators in order to determine whether or not the U.S. is actually in recession.
Interesting, Dana. This was a unanimous decision from the Fed. What do you make of the Elizabeth Warren argument just the other day in the Wall Street Journal that more aggressive interest rate hikes, this whole plan the Fed is following, will cost millions of jobs and won't actually address the cause of high prices?
Well, there are a couple of things in there. I think that, yes, there will be some job losses. Will it be millions? Probably not. Again, as I mentioned, there are 11.3 million job vacancies. So the first thing businesses are going to do is pull back on hiring intentions. And so you have to get through all of that. And then we're still going to have a labor shortage, right? And so many businesses are probably going to be reluctant to get rid of the workers that they've just bid up and paid higher benefits and wages to keep them. And some businesses will continue to need to attract workers. So we don't think there necessarily will be millions and millions of job losses. There may be some uptick in the unemployment rate, but we're coming in from a position of strength here. And I think that's very important.
Dana, I want to point out what we got in that FOMC statement. They acknowledged, quote, spending and production have softened, yet at the same time they affirmed the fact that, quote, job gains have been robust in recent months. Do you think we'll start to see the jobs picture, the employment picture pull back a bit?
Well, we were expecting this even before the Fed was going to hike interest rates, and that's basically because we're at full employment. We reached full employment probably late last year, early this year. And so if you think of employment, labor market as a giant bathtub, you have some water going down the drain, but you also have water pouring in. So if you're at the top of the bathtub, you don't need as much to pour in. So we were expecting that payroll gains are going to be slimmer. They're still pretty robust. But we could start seeing very thin payroll gains and some negative prints here. But again, we're coming from a position of strength in the labor market.
Excellent analogy. Dana Peterson, thanks so much. Appreciate that.